Welcome back, investors, to Ticker Time News. I'm Adam. And the stock market, well, it had another weak day, building on a string of recent weak losses. Now, it looked poised to stage a rebound mid-morning, with the Nasdaq up as much as 1%. But that upside momentum quickly faded, though, and the stock market sank, bringing the S&P 500 slightly below Friday's low of 36.44. The selling impulse weakened at that moment, but only for a small amount of time. And then the stock market plunged. The S&P 500 did log a fresh closing low for the year of 2022 at 36.55. That is now the new low for 2022. Now, the question on everyone's mind is whether we will get a bounce or sink lower. Well, here's what I told our investor community earlier today. Things not only look dire out there, but they also feel dire. Yet, this is what bear markets do. They make everything look bad with no end in sight. Well, I would like to say we are about to see a bounce because we are at oversold conditions. I cannot make that claim. With volatility and emotions running as wild as they are, humans and their relationship with money are very unpredictable when it comes to the markets. All I can say is that we have now feels and what looks like something very similar to past oversold conditions. Let me say that one more time. We now have this feel and look. Just by looking at the chart, we can tell this. We are in an oversold condition, just like we have been many times this past year. This market can be hard for traders for sure. Yes. Let me throw that up there so everybody can see that. This is the truest statement of true statements. When volatility goes up, trading or the skill set required for trading also goes up. The higher volatility is, the harder it is to trade the market because the price swings can be detrimental. They can be wild. They can move rapidly too. So volatility, that is the evil side to trading. Now, when we are in a bull market and everything is just booming left and right, and you can literally throw a dart and that stock will pop, trading becomes much easier because volatility is much lower. So with volatility running much higher than it was just a week ago and 2 weeks ago or even 3 weeks ago, it is becoming harder and harder and more difficult to make a good trade. So I still, just so it's out there for everyone to know, I still have my long position from last week. I have covered that position, so the losses on that are building don't become too extreme. Some of it because I always use small position sizing. That's one thing that has helped me all throughout 2022 is small position sizing. So some of my longs have been cut by stop losses, but the others, they are still there. They are still running. I did open some short positions earlier this morning because I think this market, even though it is oversold, and you cannot debate that, that's a fact. This market is oversold. I think it can still go lower. And we're going to talk about where that low might be for the near term. See, this week, this is the last week of September. And this is, if you count the last 2 weeks of September together, so last week and this week, those are two of the hardest weeks to trade throughout the entire month. So keep that in your mind too. last week and this week, they are some of the hardest weeks to trade in the 52 out of the 52 weeks throughout the year. So, with that in mind, back to what I mentioned to our investor community earlier today. We'll eventually see a bounce, but the timing of that bounce, at least right now, is unknown. So what you need to do as a trader or even an investor looking to start some long positions on some oversold conditions is to stay nimble. Number one, stay nimble. Number two, keep risk under control. The weekly expected moves that we put out every Sunday evening, if you want to think of those as one thing and one thing only, they are there to manage risk. Okay? So we have here for the SPX, 3817 is the top line for the weekly expected move. The bottom line is 3568 for the SPX. That's where the options market is saying that's the risk for this market for this week. From now until the close of business on Friday, the options market, which is the most efficient part of this market, which has not been efficient over the past several weeks, has been inefficient, just to show how difficult this market is. This is what the options market is predicting for risk this week. Okay? So, getting back to this. Number one, stay nimble. Number two, keep your risk under control. Use small position sizes. Don't jump in with half your portfolio into a play. You'll get burnt. Small position sizes. That would be number three. And number four, stick to your plan. Whatever your plan is, whatever trading strategy you have decided to use, stay with it. Traders who have a list of strategies and just bounce around from one strategy to another, because one strategy, it's just not working right. So let me go jump into another strategy. That's not a plan. That's random. You are randomly selecting strategies to use instead of planning ahead. This is the strategy I am going to use this week, and I'm going to stick with it. Have a plan, have a trading strategy, and your plan may include 2 or 3 different trading strategies. That's okay as long as that is what is in your plan. So number 4, stick to your plan. These 4 tips are very important because they allow you to take advantage of the process as it unfolds. Okay? Those 4 tips for trading this market. Remember, we are in oversold conditions. We will eventually see a bounce. The timing of that bounce is unknown. So number 1, again, stay nimble. Number 2, keep your risk under control. Number 3, use small position sizes. Number 4, make a plan and stick to that plan. Those 4 things will allow you, again, like I already said, I'm just repeating it to make sure that it's crystal clear. Those 4 things allow you to take advantage of the process as it unfolds, whether we drop lower or we get a bounce and we catch a bid and we get out of here for just a little bit. This market's going lower. There's no doubt about that. But at some point, you cannot fall for 10, 15, 20 days in a row. The market doesn't go straight down, just like the market doesn't go straight up. But oversold conditions can remain oversold for quite some time. I'm not talking months. I'm talking days to maybe a week or two. If we just go back to the last time we hit a big low, it would have to be, and let me get my highlighter here. Really, it's this drop right here, okay? This drop right here. And by the time we hit a new low for the year, the RSI was at a 27. Today, the RSI is at a 24. So we are even more so oversold than we were the last time we made a new low in the market, and that would be June 16th. And what happened after we made that new low in the market on June 16th? Well, that's when we finally caught a bid and we bounced. But then after we bounced, what did we do? We basically just moved sideways from the middle of June until the middle of July. So for an entire month, we just moved sideways. That is possible, except for right now. What's different now compared to the middle of June to the middle of July is we have gotten hit hard with some pretty bad news. And the stock market doesn't like uncertainty. And with the Fed playing hardball and tightening until it breaks something, has the market concerned for the unknown. Now, those tips that we shared with our investor community, we shared a ton of other tips too throughout the day. And I just want to say here real quick, just as a slight little detour, that if you would like to up your game and join our investor community, simply click the first link in the description. You'll get instant access to our weekly expected moves, numerous trade setups, a private Discord server, and much more. Just click the first link in the description to join our investor community. We'd love to see you there. Okay, back to this market. Now, price action in the stock market today was driven by price action in the treasury market, which itself was driven by huge swings in the foreign exchange market. The British pound, it tumbled to an all-time low against the dollar before staging a sharp recovery amid a growing belief that the Bank of England would step in with an emergency rate hike to support the currency. But guess what? There was no intervention today, and market participants had been led to believe that there won't be any supportive rate hike action until the bank's November meeting. That recognition, it fueled renewed selling interest in the pound and in treasuries. The US dollar index, let's look at that rocket ship for just a moment. The US dollar index was up 0.8% today to 114.05, which put additional selling pressure on equities, on stocks, right? The dollar blow off top that we talked about last week, well, it seems to be happening. Last week, I said, and I said it a few times, you can go back and watch those videos. I said that I believed that the dollar would end its run with a blow off top. This is nearly the definition of a blow off top. It is literally going straight up. It's like it's 1985 all over again with these currencies and with the dollar overheating like this. And yet, as we talked about last week, central banks are quiet on any potential for an accord. As if we are all on separate boats here. No. My guess is that there's going to be some sort of coordinated action on currencies. That coordinated action on currencies, I can't imagine it's too far off into the distance. I believe that it would be happening pretty darn soon. Because it's not just the sterling in Britain that's affected. Japan's affected, Italy's affected, India's affected. There's a big problem globally right now when it comes to currencies. And that's affecting the market. Let's see. Was that bear market rally the biggest you've seen? No. You're talking about back on the S&P 500? Is that what I'm going to guess that's what that is? Let's go back here. So the summer rally, is that what you are talking about when you say bear market rally? If that is what you are talking about, and I'll measure from the very bottom on June 16, well, I'll catch that wick that went a little further on the 17th of June. And we run that up to the top right here. It was about, what, a 50% retracement? This would have been 19.3%. No, there have been bigger bear market rallies than this. And what a lot of traders will base their, well, how big was that bear market rally? You won't hear a lot of percentages being thrown around. You'll hear some. A bear market rally, it could be 50%. I mean, depending on how deep of the hole you were in. But a lot of times you'll hear retracement, right? Or regression or snapback, referring to these bear market bounces. And when it comes to the Fibonacci retracement, a lot of times you can get 50, 60 on a retracement. And if we just make sure that highlighter is off, if we go here, and let me just bring this down just a little bit to bring it all into range right here, a little bit tighter. All right. So if I get the Fibonacci on here and I go to the January high and then I run it down to the June low, okay. Oh, it disappeared on me. All right. So the January high to the June low. This is not perfect, but I'm lining it up the best I can. The top, and I'll get the highlighter back out for this. The top of the rally up here, okay, right above that top, the 50% was right here, okay? So we popped over just slightly the 50% Fibonacci retracement level for that rally. And they can go much higher, right? Okay, let's clean this up here. All right, there we go. Okay, so keep your questions coming if you have them. I'll answer them whenever you have them. So don't worry if I'm talking about something. Whatever you're interested in knowing, that's what I'd rather be talking about. My notes are basically here to fill the gap between your questions. So keep them coming if you have them. Anytime is fine. You don't have to wait till the end. All right, moving on, continuing with this about the currencies. That's where I was with the dollar reaching 114. It is on a tear all of 2022, but right now, boom, it has been going straight up. This is incredible. So I expect some coordination between the central banks on currencies and some sort of action. And that would, that action to, between the central banks, that would relieve some pressure on equities because it would relieve the upward momentum on the US dollar. So that's the big thing right there. The stronger this dollar is, the higher this dollar goes up, then equities, they're going to be going in the opposite direction, right? So a strong dollar that's pointing up like that is going to equal a weak stock market. All right, let's clean this up right here. Have you been buying or holding off? Okay. I talked about this a little bit earlier, just briefly. So let me throw this up here and we'll say it. Okay. So I had long positions opened on the SPY. Some of those positions got stopped out. Some of them are still open, and I have not closed them because I do believe we are going to get some sort of a bounce sometime soon. It's just the crystal ball. I'm sorry about the highlighter there. The crystal ball on when that bounce is going to occur is too fuzzy and too shady, and I can't see through it. I wish I could. So they are still open. Today, this morning, I did play with some shorting in this market because if it keeps going down. Oh, and one other thing, the long positions, I did cover them on Friday. And then this morning, I did open some short positions so I can catch any more downward thrust or momentum that this market has. So I'm playing right now with the SPY and the Qs as my two go-to right there. I think, and I'll show you this in just a moment, for what a potential low might be. Like if we keep falling, where are we going to go? I'm going to talk about that in just a moment. But I wanted to make sure that I got to your question. I am using small position sizes. So like in our investor community earlier today, I was talking about some of the things that we're doing in this market. Small position size is critical to have and to do, making sure you have a plan, that you stick to it. You know, don't jump around with strategies thinking, oh, well, if this one's not working, let me hop to this one or to that one, and so forth and so forth. Right now, we just need to stick to something that works, right? Or in our plan, if we had a couple of different strategies that we were going to try, let them stick to whatever's in your plan. Don't derail from your plan. Stick to it, right? So just a couple things. I am not in individual stocks right now. I am only using SPX, SPY, and QQQ. Those are the only three things. And as far as a portfolio position, I right now am trading with 10%. So if I end up on the wrong side of these longs, for example, that I still have open, my portfolio is not going to be hit that extremely bad, right? It's not like I'm putting 100% of my portfolio into these three products. No, right now I am 90% cash, 10% is in SPX, SPY, and QQQ. Now, if we get some sort of a bottoming process happen, that's when I'll say, okay, let's open this up. Let's put 15% to work, 20%, 25%, and so on and so forth until we are fully vested in the market and we've got 100% of our money to work. So just pointing that out right there. I'm not buying crazy right now because I don't know if we've hit this fall that we are in right now. I don't want to use the word crash. That seems hyperbolic. But this fall that we're in right now, it might not be over. And I'm going to show you where I think, if it's not over, where I think it could be over. I want to make sure I get your questions. Let's throw this one up here. Also, I hear people always saying something will break. What exactly could break? Okay, great question. I think that the Fed is going to tighten, raise rates until something breaks. I say that phrase all the time. You always hear me say it. There can be a number of different things that break. One of the things that could break is credit. If the credit market breaks, therefore the banks swiftly tighten their qualifications for a loan, that would be bad. If the bank tightens to the point where they are not lending a lot of money, like they've made their restrictions so far off that only a perfect credit score can even borrow money. And even with a perfect credit score, you can't even borrow the money that you want to borrow. You can borrow like 1/10 of the money that you want to borrow. That's something that could break. The credit market could break. And that's basically what it means. Liquidity, slow down. Liquidity could dry up. People are not investing into the stock market. That's something that could break. The housing market, that's another thing that could very easily break. I'm using that word there loosely, break, if the Fed raises rates too fast, causing the cost to borrow money to rise too quickly, pricing and pushing too many people out of the housing market, then that could cause the housing market to break. So two things there are very critical. If the credit market breaks and the housing market breaks, again, it breaks there in quotes, that would be horrific because nobody could buy a house, I guess, if you're paying cash, but you're going to be, I mean, what is the price of housing going to do? If the interest rates have shot up so high, pushing many millions and millions of people out of the housing market, I guess the only people left who can buy a property are those with cash. So those are two examples of two different things that could, excuse me for bumping into that, my apologies, that could break, causing real harm to the market. And of course, then, if liquidity dries up and people are not investing into the market, then where's the bottom of the market going to be? It's not fun things to think about, right? So with people saying that the Fed is going to tighten until something breaks, I say it myself. And it's not that, when you get a broken arm or a broken leg, it's something, tangible, visible that you can see, right? And a doctor can go in there, put a cast on your arm or your leg, and heal you up just fine. When the Fed tightens or does quantitative tightening or raises rates, if they do that too aggressively, or they do it so aggressively that something breaks, a doctor can't just go in, fix it, you'll heal, you'll be okay, everything is fine. How, as a question, this is, how do you fix a credit market that is broke? Well, to fix a credit market that is broke, the Fed or Congress would have to offer either a bailout, like they did back in 08, 09. They would have to offer the banks some sort of guarantee, so that the credit markets could open back up, and the banks could loosen their standards again and loosen their stranglehold on the credit market and start lending again. So that's something that that could realistically occur. And then there's other examples too, not just those two examples of things that could break if the Fed tightens, raises rates, and they're too aggressive at it. Okay. So I hope that answers your question. I know it's a bit complicated to think about those major big, institutions. When you think about the credit market, the bond market, the treasury market, and so forth, how do you fix those things when they break? And then what exactly breaks? And then what happens when they, and I'm using that word break very loosely. It's more of a metaphor to say break than, or it's an easy metaphor to understand, but a complicated fix when that institution breaks. So I hope that helps. Next one up here, and then I'll get back to my thoughts here in just a moment on the market and stuff, but I want to make sure I get your questions first. They are the most important. Which S&P sectors would you likely, I'm sorry, slow down, Adam. Which S&P sector would you likely perform best when we finally get the bounce? Okay. When we finally get the bounce, and let me just pull up those sectors here. All 11 sectors were in the red today, and you can see here on the right side of your screen, this column over here, these are the 11 S&P 500 sectors right here. All of them were down today pretty steeply. Technology is one that if we do get a bounce, if the 2-year and 10-year, if the treasury market calms down, right? And if the treasury market pulls back, because let me pull up the 2-year and then 10-year. This is what will help to affect the technology sector, because that's one that's gotten pretty beaten down. US 0 to Y. And walking through this will help to understand why the technology sector is one that's ripe for a juicy bounce. Look at the 2-year right here. The 2-year yield, it was at 4.2% shortly before the Bank of England today made their update. It settled at 4.31%. This thing is shooting off like a rocket, just like the US dollar is shooting off like a rocket. And if you guys, in our investor community, if you guys noticed, we added the ticker symbol UUP to our weekly expected moves. I should have done that sooner, like a few weeks ago. I should have added that ticker, but that ticker is to track the US dollar. So we put that in our weekly expected moves this week. So I hope you like that one. Getting off topic there for a moment, but when I said dollar, boom, it popped into my mind. So we got the 2-year just taken off. It's just going to extreme levels, right? It is running very hot. And if I go in here a little bit wider, let the chart load, you're going to notice something here real quick if this chart will load. I know you can do it. Okay, going back to the dip in the market in 2019, the 2-year only got up here, let's call it 2.9%. 2.9%. We closed today on the 2-year at 4.31%. Much, much higher, right? But if I widen this up and go a little further back, I probably should have done a weekly view on this. But let me go back here a little bit further. I want to go back to the 08-09 time period so you can see what the 2-year was doing back then. There we go. You see that? Oh my gosh, it's not even on the screen. It shot up so high. This right here is what could happen to the 2-year. And if this is what happens to the 2-year, and I got to fix my screen to even bring this back down to fit, this was the crisis that led to the 08-09 financial crisis. Where did this thing peak out at? It got to a peak of about 5.25%. That could happen to the 2-year. And if it did, what do you think would happen to equities, stocks? It wouldn't be so good. Now, let's go to the 10-year real quick. US10Y. Now, remember, the 2-year is more sensitive to the Fed funds rate. So when the Fed hikes that interest rate, which right now the market's thinking 75 basis points for their meeting in November. There is no meeting in October, and 75 in their meeting for December. That would take us over 4% for the Fed funds rate. That would just be crazy for the 2-year yield. Now, the 10-year yield is more sensitive to growth concerns. That's a big one. When there's the thought of an economic slowdown, the 10-year will fire up. It has been on this smooth, accelerated, ascending trading or trend line right here. But the past few sessions, it's really fired off. Now, the 10-year today, it was at 3.75% before Bank of England made their update and said, well, we're not doing anything until our November meeting. Then the 10-year went up higher and it settled at 3.88%. When the rate of change, meaning how fast does something change, when the rate of change, or I should say, when there is a higher rate of change, that puts more pressure on something else, right? Well, when the 10-year goes up, that affects technology. Look at how far the 10-year has gone up, especially in the past couple of sessions here. It's really fired off. That pressures technology. It pressures growth. So I'm trying to give you an understanding for why I'm picking technology instead of just saying, oh, technology, that's a good one. Yeah. I'm trying to give you the why for the what. What am I picking? Technology. Why am I picking technology? Because of this. Because the 2-year, the 10-year, they've just fired off recently. So if these pull back, if these cool down, that's going to give technology a very nice bounce. Okay. And if we look at technology over here, it was down 0.7% today. That's XLK. That's the ticker I use for it. Now, outside of technology, right? Because you're asking for more than one. Right now, I guess I could say the materials sector is one that I would watch. That one could have a nice bounce. That's XLB. Communication is another one, XLC. And if we look at communication, that was down 1.6% today. That one was hit hard, XLC. So technology, materials, communications, those are some that I would lean to for a nice recovery if that occurs. We could sink lower from this point, but we could get a bounce from here too. And I know that's not very definitive, but I'm going to show you in just a moment. I know I've been saying it since the beginning, but I want to make sure I'm getting through your questions here and making sure that I get them answered. Another sector, depending on how commodity prices do, industrials could be one. But technology, that's my number one right now. And as far as a good bounce, because it has a good correlation, a good relationship to the 10-year, to the treasury market and what it's doing. When it costs more to borrow money, growth stocks get hurt more than other sectors, than other companies. So I hope that gives you the what and the why there for what I'm picking. All right, let's pull this one up right here. How low can markets go? Is the goal 2% inflation or something else too? Okay. There are several things involved in this market. All right. Let me go. I'm switching this back here to the markets. And while this is, I'm going to hop to the SPX and I'll go SPY and Q and IWM. While these are loading, let me just finish my thought on the wild treasuries and that crazy move. Those wild moves in the treasuries, they were another thorn in the stock market side today. Absolutely. And it's another reason why we didn't catch a break. Now, sorry, it's moving a little slower than I want it to. Relative strength in mega caps today, they did help limit some of the losses in the indexes today. The SPY, the Qs, they could have been down more if it wasn't for the mega cap stocks holding up. Just to give you a quick example, the Vanguard Mega Cap Growth ETF, ticker symbol MGK, gave out weekly expected move for that one this Sunday evening. That was down 0.5%. But when you look at the Invesco S&P 500 equal weight ETF, that was down 1.5%. So that just goes to show you how mega cap growth did very well today. All right, here's where I think markets could go if we continue this fall. If we see capitulation, if volatility increases, here's some important key levels that you need to have marked on your chart. And just as a reminder, if you don't have a chart to use, there's a link in the description of this video to TradingView. Click on it. It doesn't cost a penny, and you can chart too. SPX. There's this line. Let me get my highlighter right here. It's orange. This one right here. It's at 3,500. If this market continues its downward way, which, I mean, we've been red now for 1, 2, 3, 4, 5 sessions in a row. If we continue that, 3,500 is a very important level. That's the next important level, right? And I have this marked off right here, right? This percentage from where we closed today to 3,500 is 4.2% away. I'm going to show you something right here. If we look at the candles starting on the first red candle of this run, which was September 20th, we were down 1%. Next day, down 1.7. Next day, down 1%. Next day, down 1.7%. Next day, down 1%. Tomorrow, are we going to be down 1.7%? Or is this just some pattern that makes no sense? Right? Is this just some pattern that makes no sense? Oh, you are absolutely welcome. So that's a low, 4.2%. So if we dropped 1% every day, when would we hit 3,500? We would hit that this Friday. Okay, if we dropped 1% the rest of this week every day, we would get at 3,500 by Friday. Interesting, huh? Okay, 3,500 on the SPX or the S&P 500 translates to 350 on the SPY. All right, let's open this up a little bit here so you can see that. Oh. Now, the 350 on the SPY, it's not the same percentage point as SPX. It's a little bit different. So right here, okay, we've got the same group of candles going in a row from where we closed today to get down to 350. It's 3.9%. And if we dropped 1% every day, we would get there on Friday. Okay? If we dropped 1% every day, we would get to that 350 on the SPY by Friday. Let's look at the Qs. And you can see I already had all this mapped out for today. I knew this is what I was going to talk about because it's important to know. All right, let's open up the Qs here and bring the Qs up. All right, got to turn that highlighter off, which I thought I did here. Okay, now let's bring this up so you can see, and this is going to be different from SPX and SPY. From the close today, if we dropped 1% every day, as a matter of fact, this one right here, I totally jumped the gun on this one. So for the Qs, the QQQ, it's 260. That is a critical level of support. SPX, 3,500. The SPY, 350. Those are critical levels. On the Qs, excuse me, that critical level is 260. We are 5.2% away from that right now. So if we dropped 1% every day, we would hit that mark. We would hit that mark on Monday. We'd hit it on Monday. 260. All right, let's look at IWM. This is your small caps. That's what the IWM is tracking. So let me open this up here so you can see. Now, last week, I warned about IWM. I said this is not looking good. There is further downside on this, and look at how it has played out. This is just incredible. Now, on the IWM, which is the iShares Russell 2000 ETF, the weekly expected move, the bottom end is at 160. The critical level of support for the IWM is 160. We are 2.5% away from that 160 on IWM. If we go 1%, if we drop 1% every day, we would reach this, unfortunately, by Wednesday. The IWM has fallen faster and harder than other sectors. Other indices. So if we do get some sort of a risk on rebound or snapback rally, small caps, which have been beaten down harder, could have the potential for the biggest upside. But the timing on when that bounce will occur is a mystery. We can get clues here and there, but it is really hard to say definitively we're going to bounce tomorrow. Being a responsible YouTuber in the financial space, in the investing space, I cannot say with any certainty that we will bounce tomorrow. That I believe that would be unethical of me to say to you, oh yeah, we're going to bounce tomorrow. Let's ride this baby to the moon. I think that would be unethical of myself. I hope that you are holding me to a higher level of standard than even to yourself, because that just wouldn't be the right thing for me to do to you. So keep that in mind. That's part of my thought process when I'm sharing information with you. I want to make sure it's above board and it's all good, right? Okay, so we've got this here, IWM, 2.5% until we get there. So again, not far off. Now, if we do get a bounce, right, the upper end of the weekly expected move for the IWM is 174. I should have said this when I was on the Q and the SPY, what the weekly expected move is. Now, the weekly expected move, Sunday evening, everyone in our private investor community gets a copy of these weekly expected moves. We do it for 40 plus products. We constantly strive to add more. We do the major indices. We do the sectors, all 11 sectors. We do subsectors like semiconductors. And we do like your I guess what would have been called FANG stocks that have completely gotten broken down. But for the QQQ, the lower end of the weekly expected move is 264. The upper end is 286. Now, if we go down and we hit those target areas, obviously we're going to break the lower end of the weekly expected move for all of these products. But to be transparent with you guys and our investor community, you already know the weekly expected moves have been broken for several weeks in a row right now. The most efficient market, the most efficient place in this market, the options market, has been missing this, mostly on the lower end, right? All right, for the SPY, the lower end is 355, but again, that special support area is at 350. The upper end of the weekly expected move, so if we do get some sort of a bounce, maybe we could head in that direction and get close to it. I don't know how close, but that's at 380. And then we'll hop over here to the SPX and share that with you. Now, the question still on the screen here, how low can the market go? I think I've answered that, and that's short term. Because if we look at the SPX, which is a ticker symbol for the S&P 500, we have that very important level of support right here at 3,500. And if and when, my investment thesis says when we break 3,500, my target has been right here, and it has been there for months now. As you guys watching know, I haven't adjusted that box at all. It stayed right there. That's where I think we could go midterm election. Let's call it November 1st. I think we could get right in that box by November 1st, because I think the midterm election is going to add a bit of uncertainty. But after we get past the midterm elections, I think there will be more clarity in the market, and then the market will be able to rally, and maybe we'll get a decent relief rally sometime after the midterm elections. Right now, that's what my thesis says. That some point early November, we'll get a relief rally. Because, of course, the election will be behind us. So all that mess leading up to the elections here in the U.S. will be over with. We'll know who the winners are. We'll know who'll be in charge of Congress next year. So that will be behind us. We'll probably even have some clarity on what's happening in Europe over energy prices and the war itself, because there is a pretty substantial rebellion happening in Russia right now. They don't want to go to war. The citizens of Russia do not want to go to war. So there could be a big change in Russia coming up, and that would provide a ton of clarity and be a catalyst for the market to really give us a relief rally. So we've got that there. And then your second part, is the goal 2% inflation or something else too? Okay, so there's a lot of goals. What this market needs, and that 2%, so the Fed has a 2% target for inflation. The Federal Reserve wants inflation to be around 2% year in and year out, right? Well, we're still in the 8+% range. We have a long ways to go. And it's going to take time for us to get to that 2% point. Well, when could we get there? That's a good question. I don't have an answer to that one. On when could we get there? Could it be 6 months? Maybe. That would be, I think, pretty aggressive. but it's a possibility. Could we get there in 12 months, 18 months? Maybe those are more realistic, but I don't know the time frame on that. But after that inflation target, you've got employment as a mandate at the Fed too. The Fed wants, quote, full employment. Unfortunately, the Fed hiking the Fed funds rate is going to hurt employment. So right now, the Fed is tightening, meaning it's taking $95 billion out of the market each and every month. It's raising interest rates. It has not said it is going to slow down. It is going to keep up the pace. Those two things alone are being done going into a recession. And that's not good for the overall economy. That is going to weaken the economy. That is going to slow the economy down. And when the economy slows down, when people start losing their jobs, when the unemployment rate starts to tick up, companies make less money. And the comps between record-breaking profits over the past 2 years are going to disappear, are going to come up and show maybe negative growth on the extreme side. That too will bring the stock market down. This bottom that I have here, 3,500, this is a short-term low, a very short-term low, and it's an area of very important support. This box down here, that's a low as we approach the midterm elections, right? We can get a bounce from where we are. We could see a bounce tomorrow. We could see a bounce from 3,500. We could see a bounce from down here around 3,275. We can see bounces from all of these places. It just depends on where the psychology is of the market at those moments in time. Now, we can also think of next year as we go into an earnings recession as a time when the market will also sink lower. But these two marks here on your screen, these two blue lines, 3,500, and for easy remembering, we'll just call it, 3,300. 3,500, 3,300. Those are short-term levels that I think the market could go. Okay? Long-term, we'll get our bounce, and then at some point, earnings recession, an actual recession, and then we'll come on down. Okay. I think that answers everyone's questions. Double check there. Yep. I think that has. Just so everyone knows, I appreciate your questions. You can ask them at any time. It doesn't matter if I'm going through my notes or not. Your questions are what I want to talk about. Okay? That's what this whole live stream is for. Every day after the market closes, we do this live stream to answer your questions. All right. If you have any more questions, go ahead and plug them in. Until then, I'll continue going through my notes. Don't have much left. The sectors. We talked about those briefly earlier about which ones could bounce or have the greater potential when we do get a turnaround, a relief rally, or so forth. But the sectors were down today. Great long-term opportunity. Yes, it is. Yes, it is. Oh, I missed your first comment there. I hope these companies that didn't guide down get smoked. Oh, yeah, you have a great point there. So I fully believe my investment thesis we'll have an earnings recession where these companies that have had record profits for the past year, for the past 2 years, they're going to dwindle away. The comps could even go negative, which is the comparison. When you compare this quarter to a year ago, last quarter. Because 1 year you could have 100% growth. The next year you could have 2% growth. That looks like you have slowed down 98%, but you actually haven't. You continued with that 100% growth, and then you added additional 2% on top of it. But that's not how comps work. So, but that's how they are in theory. So when people see comps smaller than what they were a year ago, investors don't like that stuff. And that can cause a company to drop in the stock market. So earnings recession, when we get into the actual recession, companies are going to do worse. When companies do worse and they don't make the same margins, margin compression occurs, and then the price of the stock does go down, meaning the valuation of that company also drops. Another thing too, since it becomes more costly to borrow money, that means companies won't be expanding or growing as fast as they would be if interest rates were lower and they could borrow more money relatively cheaply, right? So that's something that's also going to hurt companies, especially those companies that have a business model of they need to grow either rapidly or they need to make acquisitions in order to keep up the growth, right? Because the organic growth can be slow in some industries, some sectors. So the business plan is to acquire other companies to grow your company. And that's where your growth comes from. But you have to be able to finance that growth. And when the cost of borrowing increases, then those companies basically stop growing until interest rates come down again. And that's detrimental to their stock's performance. So there's more than one business plan out there, and different ones can get hurt by different ways. So it's interesting to keep an eye out. Okay. So yeah, got that. Great long-term opportunity. Yes, it is right now we are in an excellent long-term opportunity. If you look at a chart, I'm going to take this chart to a weekly chart. It's going to look quite a bit different. This is still the SPX, so S&P 500. If you look at this chart on a weekly basis, so each candle equals a week. Shrink it up here. I mean, look at this. This has just been what? Back in 08, 09, it was a great time to buy. Okay, that's what history shows us. Buying the dip right here, that was excellent, because then you got all of this right here up to COVID, right? And then COVID, there was a V-shaped stock market recovery, and then because everyone was trapped at home, the stock market accelerated its growth. So you've had all this time in the market to make a ton of money. See, bull markets are great because you can make a lot of money. This 2022 right here is interesting, because this is giving you an opportunity. And even looking at it like this, for 2022, the market has barely even pulled back in relative terms when you go back to 2009 to today. It is still way up there, right? So the name of the game for a lot of people in 2022 was to preserve their wealth, because they are sitting on all of these gains. So they wanted to preserve it. Well, now the next generation of investors are coming along, and well, they're getting a pretty good opportunity right here. The thing is, you want to be patient. Okay? You want to wait for a bottoming cycle or a bottoming rhythm or a bottoming process starts. Like in 08, 09, right? It made no difference if you bought, let's say up here versus if you bought down here at the actual bottom. In the grand scheme of things, did that really make a difference? As a matter of fact, let me just do a quick little measurement. From that point to about the bottom, let's bring this out so I can see where I made my line. It was a 35% difference. So I guess, 35%, that would have been nice to have. But did it really make that big of a difference when you look at all the gains that you've had from that point until the top in 2022? No, it didn't. So just keep that in mind. The long game here, it is long for sure. And you can make a ton of money. Right now, we're in a bear market, and that's okay. You need bear markets in order to have bull markets, right? All right. One thing I want to point out here to you, and I got to get rid of this for just a moment. We're on the weekly view, right? So see this, let me get the highlighter back out. We have, this trend line right here, the yellow one. If we look at that, we pulled back right here, tapped it, and moved on. Pulled back here, tapped it, and moved on. COVID, that broke below it, and we pulled right up to it. If we look on the weekly view, we are coming up to that line. As a matter of fact, right now, that moving average sits at 35.89. 35.89. And the weekly expected move on the lower end is 35.68. That could act as a magnet, pulling it down to it, allowing for it to rebound off of. So keep an eye on the weekly chart. I think this would be the it's right on the tip of my tongue, and I'm forgetting it. I can't believe I'm forgetting it. Oh my gosh. Oh my gosh, I can't believe I'm totally missing it. But anyway, is that the 20-week moving average? Gosh, I'm drawing a blank for some reason. Oh, I can't stand that. Live too. Anyways, on the weekly view, it is at 35.89. That could act as a level for whatever this falling is that we're happening, as long as we don't capitulate. and go down to 3,500 even, that could be a good area for a bounce. The lower end of the weekly expected move, because it lines right up with that. And history shows us that has been a significant point. We even broke down and bounced off of it back here as well. Now, it's interesting. 2008, when we got to it, we initially bounced when we touched it. This is actually pretty important, I think. And I've seen this before many times in my research. I just never thought to bring it up during a live stream. But when we first got to it, we bounced off of it, right? And there was a very nice relief rally when we bounced off of this. As a matter of fact, let me measure what that rally was. Oh, get out of the way. You're in the way. It was a 12.8% rally off of that moving average. Then, after we broke that moving average there, and we had that 12% plus rally, we came back down, we went through it, we came back up to test it, we were rejected, and then that's what led to the huge sell-off in 08. So that's important. On the weekly view, that's important to keep in mind, because we are approaching that moving average. Okay? So keep that in mind. That's at, again, 35.89 is where it sits right now. Okay. Went through that. Let's see here. I know someone that works at Best Buy, and he said that it's really slowed down in the past 3 months. Yes, consumer spending, I believe, is slowing down very quickly. Companies are going to run into a problem of having too much inventory. That itself will lower margins and put pressure on margins, because when you have overstock of inventory, it can it can break, it can get mixed up and lost, it can get stolen, and that just costs the company money. So companies have that to worry about too. And in my investment thesis, that's what goes into, that's part of the earnings recession, too much inventory. Consumers, like I've said since the beginning of the year, the first half of the year, consumers were strong, they were healthy, they were spending money. Middle of the year, consumers are weakening, they are tightening up their budgets, they're not spending as much. And by winter, by the end of this year, I believe consumers are going to be weak, which means they're not going to be spending a lot of money, and they're going to be budgeting really hard, and it's going to be very difficult for them to make ends meet. So I absolutely I've seen that too and heard that too. Last question here. Where do you see SoFi going? It's slicing through any and all levels. Yeah. For your growth companies, they are going to go through pain. A lot of pain. Okay. Right now, let's go to SoFi. SOFI. Right now, the market has shifted to growth stocks are bad, risk off. We need to preserve as much capital as possible. And that's why the market is sinking so fast right now, is because investors are worrying about their retirement, worrying about their wealth. Now, I've got SoFi here on a weekly time frame. And on a weekly time frame, let me pull it up here a little bit. There is a little bit of support here on this weekly time frame that we can see. Let's just pull it up some so we can see better. Now, if we go back to July, the beginning of July, we had a low. I got to move this so I can see what it says. A low 517. The following week, 514. We've broken through that, which to me is to be expected. SoFi will go lower. I mean, just think, the S&P 500, it made a new low for 2022 today. So it does not surprise me that SoFi here has also made a significant low. Now, it hasn't reached its 52-week low right now. That's at 482 is its 52-week low, which I believe would be, I think it's its all-time low. I think SoFi is a wonderful company. I believe in SoFi. I think SoFi has a great future. I think it will be a winner overall. I think it's a good investable company. But you do have to understand the overall market conditions right now are extremely, I would call them, I definitely would call them extreme bearish. Extremely bearish. And when the market gets extremely bearish and even extremely bullish, it loses any sense of being logical. Okay? So anything can happen when you're not being logical. So hold in there. Watch the chart. When the overall market starts to turn around, and remember, when you're buying these growth companies, you don't have to buy these growth companies exactly at the bottom, right? We all know that timing the market is not a good idea, right? But that doesn't mean, just like when we looked at the grand scheme of things from 2008 until 2022, yeah, there might have been a 30% difference from buying at the peak and the trough. But overall, did it really matter in the grand scheme of things? From 2009 until 2022, you were going up and to the right on the chart. And that's exactly what you'd want it to do. So you don't have to buy SoFi today. That's okay. If you have already bought SoFi, that doesn't mean that you have to sell. But that is a decision that you will have to make. I cannot make that decision for you, because this is just entertainment, right? For entertainment purposes only. But even though that saying is there, I'm still trying to be as honest and as forthright and as factual as I can. So, I hope that answers your question. I do believe SoFi will go lower. I don't think it's seen its bottom yet. In the grand scheme of things, if SoFi is a $100 stock, does it matter if you bought it at $5 a share versus buying it at $10 a share. Does that really matter? In the grand scheme of things, I don't think it does. At least for me personally, it doesn't at all. I don't care. I don't care because I'm not trying to pick bottoms. I'm just trying to pick winners. When I'm playing the long game, okay? When playing the long game, I'm not trying to time it. I'm just trying to pick good companies. Companies that will be around in 10 years, in 20 years, heck, in 50 years. So I guess that I should probably put that in our advice section on our Discord server, that you don't have to time the market. When you feel it's right, after you've done your due diligence, then it's right. And nobody can determine when it's right except for you, for yourself. Okay, we've been going at this for an hour and a half. I cannot believe it. I greatly appreciate all your questions. I obviously did not get through all my notes, but that is okay. I don't care whether I get through all my notes or not. I just want to make sure that you're getting the value that you want from this live stream. Let me just really quick go over what we can expect for tomorrow, because we've got some economic data tomorrow. You are greatly appreciated. I'm here for you. I greatly appreciate that. Thank you very much. And you are welcome, my friend. But I'm here for you. Every single day the market is open to talk about it. Okay, I greatly appreciate your comment too. And I greatly appreciate each and every one of you who are watching as well. Okay, let's talk about tomorrow, a couple of expectations on the economic data front. First off, let me just fix this real quick. On the week, let me change this back to the daily view real quick. All right, let's go over tomorrow's economic data. At 8:30 a.m., we get the August durable orders. The expectation is negative 0.1%, which is barely anything at all. And the last reading, durable orders was flat, 0%. And then we also get durable orders and we take transportation out of it. That expectation is 0.3%. The prior reading was the exact same 0.3%. So not a lot happening there. Then a lot of housing data tomorrow. 9 a.m. Eastern, we get the July FHFA Housing Price Index. The prior reading was 0.1%. Not a lot of movement there in the housing market. We also get the July S&P Case-Shiller Home Price Index. The expectation is 17%. That is down from the last month's reading of 18.6%. Then at 10 a.m. Eastern, we get the September Consumer Confidence. Consumer confidence. That could shake up this market a little bit tomorrow, but we all know the price points to look for in the market. The expectation is 105, which is an expectation that is slightly better than last month's 103.2. All right. And then more housing data. We get the August new home sales. The expectation is 500,000 units. The prior reading was 511,000 units. So the expectation for new homes is slightly under last month's reading. That's it. Those are the biggest reports that come out tomorrow. A bunch that will affect the housing market. One ETF that tracks the housing market, XHB. This is the home builders ETF. If new home sales comes in under that 500,000 level, you could probably expect the XHB home builders ETF to drop. If the number is above, new home sales are above that 500,000 unit expectation, and even greater than the 511 units from last month, then I would expect some sort of a bounce out of the home builder ETF, XHB. And then, of course, you've got the main S&P 500 sector, XLRE. That will definitely be affected with tomorrow's housing market data. Okay, that's it for tomorrow. Let me just say thank you guys so very much for your questions. I greatly appreciate each and every one of them, and I appreciate each and every one of you as well. And just do me a quick favor here before we wrap things up. Click that like button real quick. Takes a second, and it helps out the channel. And then also sharing this video with a friend. You become the notification by sharing the video. Share it wherever you can. And that would be very, very helpful as well. And if you like the information here, you are welcome greatly. If you like this information, consider clicking the first link in the description. That's our private investor community. Weekly expected moves, 40 plus different products. We even do experimental daily expected moves. We publish those sometimes, but we're working on that, fine-tuning that one. We also do numerous trade setups and 16 different trading strategies. So we are doing all of the scanning for you and then putting that together so you know what stocks fit your trading strategy. We share a ton of economic and market insights. Just today, we talked about using FinViz and the Hammer scan for FinViz. It's a great scan to use for this specific time in the market. Those hammer candles, they can work out. They can be pretty good. One other one I would be looking for is a reversal candle, which today could count as a reversal candle. It's when you have more wick on the top, but who knows? This market's not rational right now, so that may not work. But it is another cool one that's out there. You also get top 10 stocks. We do it in a couple different categories. Growth, dividend, value, momentum, just packed with information to help you along your investor journey so you can win at this game of investing, right? All right, ladies and gentlemen, I'll wrap it up here. Thank you again so very much for joining me, and I'll see you tomorrow after the markets have closed. Take care.